So we get lots of questions about what do I need to see or what do we need to see when it comes to the economy, for me to change my mind or not to be so nervous about the markets over the next 6 to 12 months. And there are a few things. The Fed needs to address that they are seeing signs of inflation slowing. Doesn't mean that they have to say that they're going to ease, but they have to see something because right now they're bulls to the wall. It's crazy. And people looking at this, I'm even seeing not a lot, 2 or 3 economists, listen to this podcast, but starting to say, listen, the Fed's pretty crazy. They're looking to go over 4% without even looking at what's coming out ahead. And if you look at the last month and a half, 2 months of data, holy shit, what a difference it was compared to the 2 months prior. Massive. And yes, we're still up. I'm not saying 6-7% inflation. Holy shit. But it's drastically coming down. And it like in a light switch. And we're seeing it industry to industry to industry. We saw it with oil. We saw it with retailers immediately. Holy shit, we have tons of inventory out of nowhere. What happened to those supply chain concerns? Chip market now in a glut. What the hell happened? I thought they couldn't get enough supply. Now you're in a glut. Like immediately it happens. When demand shuts off, it shuts off like a light switch. That's why it's so tough being in the retail business. And people change in days. And it's almost impossible to predict. You try to predict it, but it's difficult. Obviously, the people with the best algorithms in the world, Target, Walmart, Amazon, got this totally wrong. Bulls on the wall producing, holy cow, we got to get our supply chains better. And they did a great job and then got all this inventory and holy cow, demand out of nowhere stopped. These are the guys that know everything about everyone in the world, and they got it wrong. Now, the Fed needs to address this. Hey, inflation is slowing, but we're going to keep our eye on it. That would be good. We're going to get a hot CPI number based on rents, which are starting to come down, but will take time. And rents are fixed, right? They go up year over year. Yes, they're up significantly year over year. I think month over month is starting to come down. But it's not like, holy cow, food, I need to buy it. It's not like your rent's going up every single month. It's getting adjusted maybe a year or maybe 2 years, 3 years, depending on your lease or whatever. But it's going to take a while for that number to come down, which means it's going to be a hot CPI number. So hopefully the Fed doesn't just say, hey, okay, high CPI, we need to come down faster and we're going to raise. They continue this rhetoric of we don't see any signs of inflation slowing. We're going to continue to aggressively raise rates into next year to control inflation no matter what. It's going to be terrible for equities. It's going to be horrible for equities. You know why? Because we're in a zero growth market. I mean, you look at GDP numbers coming down, they're crashing all over the world. And countries are sitting on more debt than any time in their histories. By raising rates, can continue to raise rates, we're increasing the cost of servicing that debt. Is the Fed monitoring that? Are they seeing what's going on with other countries? I mean, Russia's still a wild card. One of the things I would love to see, some easing of tensions. I mean, if this happens over the next 3-6 months, which is unlikely, not seeing any signs of that. We're going to see food prices come down. Also, oil prices pull back even further, most likely. That would be great for the markets. But the data, we need to see data. If you're asking me, what's going to change, we need to continue to see data that's showing inflation is moderating. I mean, you saw PwC come out with a study suggesting or estimating, based on their survey, that 50% of companies in the S&P 500 are going to be laying off workers. I think that number is conservative, since earnings are declining year over year when you strip out energy. And it's important to strip out energy. We're not just taking it and stripping it out like the stripping out food, energy, whatever. But energy is a major component. It's on fire. Without it, we would have saw earnings decline 4% year over year. Instead, they're up 6%. That's the difference in energy, where profits are up close to 300% year over year. 300% for a sector, not a company, a sector. That might make sense to you looking at prices, but 300%? Holy cow. But speaking of earnings, we need to see estimates come down. And you know what? We are finally, like the heavens, finally seeing it. This is FactSet who reports. I tell you, this is free information. It's one of the greatest reports that you'll get for free, market related. Just go into Google, type FactSet earnings. It just came out. This is data I believe is from yesterday. So analysts have lowered their estimates significantly into Q3, as July and August, which we all know, have been slowing dramatically. Dramatically. So July and August are what? The first 2 months, which are calculated to next quarter's earnings, with September being the third. July and August have been incredibly slow, to where earnings estimates have been lowered by 5.4% in August. That's how much the S&P 500 earnings, when they package them all together, all the earnings, that's how much it's been lowered, 5.4% in August. Those estimates. You don't hear about this. You're only going to hear about upgrades, downgrades, and when they report, you're going to say, did they beat that number? Did they not beat the number? You're not going to know that number was $2, but now it's $1.50, and then they report $1.60, and everybody celebrates and say, wow, they beat by 10 cents. That's what you're used. That's what they're conditioning you to believe. It's still, the number's still $1.60, and it was supposed to be $2. That's my take on Disney when they say they beat the numbers. They're losing more money than they ever lost. Their earnings have not even come close to going back to pre-COVID levels. One of the only companies in the Dow that could say that, outside of Boeing. But yeah, they're beating because estimates have been lowered. Now, let's put that in perspective. That 5.4% in August, because that's just, hey, it's a percentage. It sounds like it's small. Is it big? I don't know. You got to put things in perspective. If you go back 10 years, the average decline in earnings per share over the first 2 months of any quarter, this is FactSet for you, great research, have been 2.7%. This is double that. That's a massive revision. Massive. It shows you that earnings are coming down significantly. So the revisions are more than double the average, and I got news for you. They're going to come down even more. That's why companies are seeing this. If you strip out earnings and you look at the rest of earnings, for the rest of the S&P 500, those sectors, they're coming down. When you see earnings coming down year over year, it means that you're going to probably lay off employees. You have to cut costs. That's the easiest way to do it. And if you're looking at the earnings, it's broad-based. This is 9 of the 11 sectors have seen the estimates cut by analysts, which is a good sign. This means that expectations are being lowered. However, if you look more closely at the data, which I did, and I want you guys to take a look at this. If you're on our YouTube page, you could see it. If not, if you're listening to this, pull it up on FactSet, and you're going to be amazed. Because you look at earnings, they're going to be pretty bad next quarter, to where they've already been revised significantly lower, but we're likely to see this for the next 2 to 3 quarters, where we could see negative year-over-year earnings per share. I would say growth, but it's not growth, which is basically an earnings recession. You're not going to see it because you got to strip out energy. But you know what? Let's bring some of this up, and I'm going to share it right now. So you're looking at the sector level S&P 500. I'm just going to change this input really quick so you can see my arrow on here. So S&P 500 sector level change. Then this is Q3 2022 earnings per share. I'm going to explain everything, even though some people will be watching this way. If you're not watching, you can understand it. If you look at energy, so the sector level change in Q3 2022 earnings per share, right, from June 30th to August 31st. You're looking at energy is up 9.6%. And remember I said 9 out of the 11 sectors? The other sectors, real estate, it's up 0.1%. Now look at the rest of the sectors. Utilities, okay, flat. It's down 0.1%. Financials down 4%. Industrials down 4%. S&P 500 overall, again, down 5.4%. Healthcare down 7.5%. Materials down 7.9%. Consumer discretionary down 8%. Information technology down 9%. Communication services down almost 13%. I mean, this is recession all over it. You strip out energy, you got recession all over this. I mean, it's crazy. So these are the earnings revisions. This is how much, if you're looking at it. On average, it's 5.4%, which will give you a bottoms up. But if you're looking at these numbers, it's insane of the declines that we're seeing, of how they're pulling back finally, which is good. That's a good sign. If we keep going here, there's other things here that I wanted to show you. So looking at S&P 500 calendar year 2022 compared to calendar year 2023 earnings. Okay, this is all the earnings, guys, that are packed into the S&P 500 together. Okay, if you take them all together, they're expected to finish the year at 226. Last year, I believe they closed at 210. So we're still going to see earnings growth this year, despite how terrible the market's been. Do you really think we should be seeing earnings growth? No. A lot of that is energy. But 226 is a big number. But more importantly, they're expecting 2023 to be 243. So $243 in earnings with all the S&P 500 companies together. That's over 7% growth. And at 226, that's 7% growth from last year. In recessionary times when GDP is slowing, where companies are looking to lay off employees, where you're seeing inventory concerns, now you're seeing supply chain gluts in semiconductors, you really think earnings are going to grow close to 8% annually over the next 2 years, this year and next year? There's no effing way that's going to happen. There's no way that's going to happen. I mean, it's crazy when you think about it. But you get to net profit margins, it gets even crazier. Right? Net profit margins. People are like, oh, well, we have to raise prices. We have to raise prices no matter what because of inflation. It's amazing. Net profit margins are incredibly high. They're higher than the 5-year average. They're well over 12%. That's something I could show you as well. But if you're looking here, energy was the largest contributor. So when you look at net profit margin for the S&P 500, you're like, well, they're keeping up with their margins, which is good. That should be good for stocks. Yeah, but you got to break it down further. Because if you look at energy, their profit margins went from 6.5% to 14.4%. It's a major percentage and major part of the net profit margin of the average. But they even say, on the other hand, 9 sectors are reporting. I've reported a year-over-year decrease in their net profit margins in Q2 2022 compared to Q2 2021. 9 out of 11 sectors, right? And that's right here on the FactSet report. 9 out of 11 sectors. Again, YouTube, absolutely free. You can see the charts. I like bringing this stuff up when I'm going through it. That's pretty crazy. You're seeing profit margins. What does that mean if profit margins are coming down? It means that you're not seeing inflation. Yeah, you're seeing it in energy. Energy prices have come down. They're still up year over year. Again, they're going to be stubbornly high, even at $86, but natural gas prices are through the roof still. Still close to their highs. They're $8.50, and I think $9 with their highs, whatever. And forget it where they are in Europe. I mean, I don't mean to laugh. I'm laughing sarcastically, but holy shit. I mean, it is crazy over there. It's a crisis. I mean, people could die because they're not going to have the energy to heat their homes during winter. It's crazy there. It's absolutely crazy. But you're looking at those net profit margins, what does it tell you? It tells you that the Fed rate hikes are working. They're working, but the Fed is just totally blind. I don't know if they're blind or it's just Fed speak because they don't want to stimulate the market. They don't want money to right away. Holy cow, let's go. It's going to go higher. Everybody's going to be all in. No, I get it, but they are really, you don't have to go that far and say no matter what, they're going past 4% and we're not even going to ease them for the next 16 months like they can predict more than 3 months. We've seen the Fed's track record over the past 2 years. It's the worst. It's the worst ever. If you had a 4-year-old kid, they would have predicted the market when it came to inflation better than the Fed. It's a joke. You're supposed to be the smartest guys in the room. I mean, you couldn't have been more wrong than them.